one operating cycle. Let's talk about liquidity. Now, we know that a company has assets and liabilities and equity, and part of that liability is considered current liabilities, which means these have to be settled within 1 year or one operating cycle, whichever is longer. And your current assets are what can be used to settle these current liabilities. Now, if your current assets are more than your current liabilities, in general, what we can say is that your liquidity is good as a company because you have assets that are either cash, because current assets, of course, includes cash, or it includes marketable securities, or it includes accounts receivable, or it includes inventory, and all of this can be converted to cash. And your current liabilities might include accounts payable, so you can use this cash or marketable securities or convert your account receivable and inventory into cash to pay for this accounts payable, which basically means that if your current assets are greater than your current liabilities, then your liquidity position is good. Now, I just want to talk a little bit about liquidity versus marketability. If you can convert something into cash, that is marketability. Let's say you have a home, a $1 million home, and you can convert this to cash. But if you have to do it overnight in an emergency basis, you're probably going to take a significant hit on the price if you have to sell it overnight. But if you have, let's say, $1 million in US Treasury bills, you can convert it into cash for almost the same amount of money. So that means your real estate property is marketable, but not that liquid. Your US Treasury bill is not only marketable, it is also liquid. So it's not only the ability to convert something into cash, to generate cash, but also at the lowest possible cost. Now, at the beginning of this learning module, I had talked about good sources of liquidity and bad sources of liquidity when I was going through the contents with you, where we said primary sources of liquidity and secondary sources of liquidity. So primary sources of liquidity is the cash that you have, the marketable securities that you have. But secondary sources of liquidity would be selling your assets. Now, naturally, that is not a good thing, especially if you need those assets to continue your business. So using primary sources of liquidity has no effect on your ongoing operations. However, using secondary sources may have a negative impact on the company's ongoing operations depending on what are the assets that you are selling. Now, within primary liquidity sources, you've got the cash that the company is generating, net of any investments that it has to make, whether short term or long term. It also includes any cash that is available in the bank or any securities such as bonds or stocks that can be sold quickly without much loss of value. And within primary sources are new loans that we can take, right? New borrowings from bank. And of course, this does create a new obligation but retires an old one. So it is considered a primary liquidity source because it is not going to hamper your operational ability. Secondary sources, however, are going to hamper your operational ability, especially if you are selling assets. Even if you are renegotiating debt contracts, this is going to give you a bad name. your cost of debt is probably going to go up. If you're going to issue additional equity, your cost of equity is probably going to go up because your investors, your equity holders will feel that you are running out of cash, you're running out of liquidity, and you are being forced to share your profits with other people. You're being forced to dilute your shareholding because you are running out of cash. Other examples of secondary sources include not paying dividends to your existing shareholders, so either you suspend them or reduce them, delaying your capital expenditure projects. Maybe you were doing it to maintain your existing property, plant and equipment, or maybe increasing it, so either you reduce that or delay it. And of course, the worst possible situation could be where you file for bankruptcy and try to reorganize the company. Now, every conversion to cash is going to have some impact unless you're dealing with treasury bills, which is probably the safest investment. And in this example, you can see that there is a 0% hit on converting your short-term marketable securities. Your inventories and accounts receivable, if they are being liquidated on short notice, you can see there is a hit of 10%, which is substantial. Real estate is taking a hit of 15%, and a subsidiary company is taking a hit of 20%. Now, please pause the video and try to calculate what will be the total amount of money you will get if you liquidate all these assets. So hopefully you were able to get 94.5, because from all these assets, given the amount of money that you will lose in liquidation, this is that money in dollar terms. 0% of 10 is 0, of course. 10% of 20 is 2, 15% of 50 is 7.5, and 20% of 30 is 6. So that is the amount of money you're going to lose, and this is the amount of money you will be able to recover, and the total of that is 94.5. Now, what are the factors that affect your liquidity? There is two perspectives of this. One is the drags, that whatever your inflows were, they are being dragged, such as your people are not paying on time, your customers, your clients, they're not paying on time. You have some inventory which is not being sold. Let's say you bought some Apple iPhones 14s and the 15th came out and your 14th is now slowly selling, or your credit situation is getting bad. So all of this is going to slow the inflows. Whereas what can accelerate your outflows is going to be a pull on liquidity. Let's say your suppliers start asking for earlier payment. They stop giving you such big credit terms. And your banks start asking for their money back. So this could all result in a pull on your liquidity. Now, how do we, as an analyst, how do we measure the liquidity of a company? If you're investing in a company, of course, you want to make sure that they are fairly liquid and they're not going to run out of cash. They're not going to have to file for bankruptcy. So how do we go about doing this? Now, there's three formulas over here: current ratio, quick ratio, and cash ratio. And as you will see, all of them have the same denominator, but the numerator is different. Now, what I like to give over here is an example of COVID lockdowns. And think of a company that has gotten locked down and they're not able to sell their assets, but they still have to pay their current liabilities. So if we measure their liquidity based on all their current assets as a percentage of all their current liabilities, it would be unfair, because inside your current assets there is also inventory, and during a lockdown you're not going to be able to convert that inventory to cash. So it's kind of unfair to take inventory in the numerator when calculating this liquidity ratio. So which brings us to the second liquidity ratio, which is quick ratio. And as you can see over here, inventory is not there in the numerator, right? But still accounts receivable is there. Now again, think of the COVID lockdown situation. Do you think it will be practical to assume that you can approach your customers, your clients, and ask them to pay their dues to you? Will most of them pay? Most likely not. They're going to say, sir, ma'am, we are in a difficult situation. It is lockdown right now. We are not getting the money from our clients. We cannot pay you right now. So a safer situation, a safer ratio to calculate is something called the cash ratio, where we even don't take inventory and we even don't take account receivable. We only take whatever cash and marketable securities that we have. And if that is more than the current liabilities, then that means we are in very, very good shape as a company, because we can pay our current liabilities using just the cash and marketable securities that we have. And this exhibit from the curriculum shows in a graphical manner that your current ratio is all of your current assets over current liabilities, but your quick ratio gets rid of the inventory, and your cash ratio gets rid of the inventory and the accounts receivable. Now coming to the final discussion about your aggressive approach, your moderate approach, and your conservative approach. So business, it doesn't grow in a straight line. Business kind of grows like this. So your financing needs also grow in steps. So what you could do is have a very low level of long-term finance from the bank, and all this growth needs you can meet with short-term financing. Now, what's the risk in this approach is that short-term financing is subject to rollover risk. There is a lot of rollover risk. Now, what does that mean? Rollover risk means rolling over that financing facility. So let's say you take an annual loan, yearly loan, and after 1 year you have to renew it again. But what if the bank doesn't want to renew it for you? Then you will be stuck because you're depending on it. Compared to that, a conservative approach would be that you have long-term finance more than your requirement, and therefore you're not having any rollover risk, because you, let's say, arranged a 10-year or 15-year or 20-year loan which is more than your requirement. So you're playing it safe over here. And then of course you can have a moderate approach where your long term is very, very carefully going up, and then the short term peaks you are financing with short term. So that is a good approach, of course, moderate. And conservative is also a good approach. Aggressive is definitely not that good an approach. So how do you go about doing this? Of course, you need to do your projections, that what is going to be the business financing requirement, right? What levels of inventory, what levels of receivable, what levels of payables are you going to have? And that, of course, is something that your accountants will be doing in the company, the budgeting that they will be doing, the cash budget that they will be making, and they will come up with your projections for what is the level of capital required in the business. And then based on that, how much are you going to get from long-term financing, how much are you going to get from short-term financing is what is going to determine whether we are going to go for an aggressive, moderate, or conservative approach. And let's discuss each of these now. First, we'll discuss the conservative, then the aggressive, and finally the middle moderate approach. Now, in the conservative approach, what's happening is that within our requirement, of course, some are permanent current assets which are already there, right? And then some are temporary, which later become permanent, of course, as business continues to grow. But temporary, there is a certain variable current asset that is temporarily required as business booms, but then it becomes permanent later. So in the conservative approach, not only are your permanent current assets financed with long term, but even your variable current assets are financed with long term. If this was moderate, then the long term financing would be underneath over here, which is only financing the permanent requirement, not the temporary jumps over here. But if this is a conservative approach, then the long term is on top of the business requirement. So not only are you financing your permanent current assets, but even the short term jumps in account receivable and in inventory requirements, even that is being financed by long term debt or equity. Aggressive approach is the opposite, that even your permanent current assets are being provided for by short term, because your long term is so less that even your permanent current asset requirement is being financed with short term. Very, very high rollover risk over here. And of course, your moderate approach is that you've got your long term financing keeping up with the business growth, and the short term jumps are being funded with short term. So your variable current assets funded with short term debt and payables. So of course, this is a good approach, optimum approach. And your curriculum mentions the pros and cons of all three of these approaches, starting with conservative. Now, conservative, it's safe, stable, minimizes or avoids rollover risk. The financing cost is high, of course, higher interest rate because your long term debt is there, but at least it's known upfront, right? So you're compromising on profitability over here because you're paying a high interest cost, but you're playing it safe with your liquidity. On the other hand, you've got a very dangerous situation with your aggressive approach where you are dealing with rollover risk, which means your liquidity is low. You might be having higher profitability, but this overall reduction in interest expense comes at the cost of this lower liquidity and higher rollover risk. And at times it's not worth it, because it might be once in 30 years that you face this disruption. And think of Lehman Brothers. So many examples are there that all the effort of so many years gone to waste in just one disruption. And then of course you have your moderate approach, which is best of both worlds. Now, which companies seek to implement a short-term financing and how do they go about it? Well, first of all, it really depends on the size of the company and if they are able to borrow efficiently in the short-term funding market. So first they need to understand what is their objective, right? And how they can meet that objective in terms of the diversified sources of credit with a cost-effective rate, and not only considering the obvious or the explicit costs, but even the implicit costs. So let's say they issue commercial paper, which is a short-term financing option. But issuing commercial paper, let's say at 4%, is the explicit cost. There's going to be a cost associated with issuing this paper, right? Which might be paid to an investment bank or whichever consultancy company is going to help the company raise this finance. So we have to consider both costs. And again, not everybody is able to issue something like commercial paper. Only companies with very, very high credit rating are able to do it. So if you are a large company with a high credit rating, then maybe a moderate approach or even an aggressive approach is something you can do, because you will have easy access to short-term borrowing and your rollover risk is something that you can afford to take. Also, if you are a utility company with very, very good stable assets that can easily be used as collateral for getting secured loans, then maybe you can go for an aggressive approach. So I'm not saying aggressive approach is always bad. It depends on case to case basis. But generally, it is better to be safe than sorry. So what have we discussed in this entire learning module? Number one, we learned how to calculate the cash conversion cycle, where you take your DSO. First, you take your inventory on hand and you minus your days payable outstanding, and then you add your days sales outstanding. The whole objective to shorten this cash conversion cycle is to reduce your inventory on hand, is to reduce your days sales outstanding, and increase your days payable outstanding, which is the amount of money you are pulling from your suppliers. Then we talked about these three ratios, in which of course the cash ratio is the safest. Then comes your quick ratio, and then of course comes your current ratio. Quick ratio doesn't include inventory, and cash ratio doesn't even include your account receivable. Then we talked about the different approaches: conservative, moderate, and aggressive. And we talked about how a company can go about managing their short-term financing, where they should know what are the sources of their short-term financing, what are the costs of those, such as both explicit and implicit costs, such as those for your commercial paper, and what is the level that is going to be there of these cash needs.